Private fixed-income bonds and loan notes are known for offering qualified investors a high rate of return on their investment. It's not unusual for these instruments to offer annual interest rates of between 8 to 12%, and sometimes more. To understand how the issuing companies justify such an attractive interest rate, we can examine the various benefits that private bonds offer to the borrowing firm, namely speed, cost, flexibility, and privacy. Speed. Private fixed-income bonds and loan notes can be created swiftly as and when needed. Each bond or loan note is an agreement between two parties, setting out terms of the lending facility on one side, and terms of interest payments and return of capital on the other. Such agreements are common, and the corporate lawyers can rapidly create documentation to satisfy both parties. This allows companies to raise finance quickly when needed, for example, to seize a new development opportunity. Cost. Private bonds are much more cost-effective to issue than publicly listed bonds, involving fewer administrative and regulatory requirements and reducing underwriting and legal expenses. They are also more cost-appropriate for a relatively modest or short-term borrowing requirement. Flexibility. Private bonds and loan notes provide borrowing flexibility to a business. Not only can the notes be switched on or off to match funding requirements, but the commercial terms are straightforward to adjust. The interest rate paid, the maturity of the note, and payment dates of interest coupons are all easily amended to match business needs. Privacy. By privately issuing debt instruments, companies can raise funding for special projects or to expand operations, and at the same time prevent commercially sensitive information from entering the public domain. Confidentiality can be particularly important in highly competitive business sectors. Any or all of these factors can be crucial to a company raising finance. Plus, in an environment where the central bank base rate is over 5%, bank business loan rates can be anything up to 15%. Moreover, lending banks impose conditions and restrictions that can be strict and less friendly to the nature of the business. All things considered, private fixed-income bonds and loan notes provide a win-win for the investor and the bond issuer. The investor achieves a stable return, which is fixed and known in advance, while the bond issuing company accesses flexible and cost-effective financing at the times it is needed. This allows firms to act when a business opportunity arises and to forward plan investing in growth. To find out more about investing in private fixed-income bonds, make sure to download our free guide, available from the Fixed Income Genius website.